What is the break-even point in units and dollar value of sales? Well, to start with, an organization needs to know at what point in its operations, that is, in what point of sales, does it cover all of its fixed costs so that it reaches a point where it's neither made a loss nor a profit. That's known as the break-even point. So it is a point, again, where you have delivered and received enough value. Now, the general metrics there are this. You have the product price that you charge something. I can charge $10 for something. If it costs me $5 to make it, then the profit from that would appear to be $5. But if I have other expenses, my fixed costs from overhead that otherwise don't change, I need to have enough money there in that $5 to cover overhead. Well, with that being said, the overhead is a fixed amount. Okay, so if my overhead were $50, I would have to sell 10 units to make that $5 equal 50. So in summary, that's how it works, right, in terms of units. And then if I sold 10 units, right, what is the cost, or excuse me, the cost of those units that I sold? So 10 units at $10 is $100 worth of units. So I'd have to have 100 sales dollars to cover it. Now, rather than have to think through a scenario like that and to use the actual metrics, let's look at the formula. Okay, so to start with, the break-even point for units, you'd simply take your total fixed cost divided by your price per unit minus your variable cost, just like the simple example I gave. That would give you, once again, the total number of units, right, that you would need to sell in order to reach that break-even point. Okay, oftentimes it's not going to be an even number. It'll be some fraction of a unit. So in between the sale of that unit n or unit n plus 1, right, the next unit is where it's going to fall. But anyway, it will tell you at what point you reach break even. Now, if you need the calculation in dollars, right, that's a relatively simple formula too. But so that you're not confused when you hear these terms, here's generally what goes into it. So you take your total fixed cost again, and you're going to divide that, instead of by price per unit minus variable cost per unit, you're going to divide it by the contribution margin, which is very similar. It's the price per unit minus variable cost per unit divided by price per unit. So it's a percentage. Okay, it's not a dollar value. It's not. So in the break-even units, you have a dollar value divided by a dollar value. Both cancel each other out, so you get a number value, right? And that's the number. Well, you need to make certain that you keep one of the dollar values, so your total fixed cost, you're in a dollar value, right, divided by a metric, a percentage in itself. And again, that will keep it in the form of dollars. So price per unit minus variable cost again, but then you divide that by the individual price per unit. So basically what you're doing there is you're dividing the gross profit from the sale of a unit divided by the price per unit, and that's going to be your contribution margin. Then you can once again divide total fixed cost by that, and that gives you your break-even point in sales dollars.